Can you hear me all right now?
Yep, we got you now.
Great. Hello, everybody. Good to see you all. Thanks for hopping on today's Zoom call. Good to see you. Hope you're all doing well. We want to spend some time today talking about the mortgage market, kind of where we've been, where we are, where we think we might be going, and then answer any questions that you might have. You're all on mute, but while I'm talking today, if you have questions, go ahead and stick it in the chat feature there on your Zoom, and we'll get to those maybe towards the end, unless there's something that you want answered right away as I'm talking. So let me just go through and jump right into things. I'm the president and CEO of Inspiro Financial. As you all know, we're the affiliate lender of Everest. Love working with the Everest family and community, and hope we can get the chance to work with all of you. But today's point is to kind of talk a little bit about a few things. Number one, I want to give you a little bit of background on how the mortgage market works. I think most agents have a pretty good understanding of interest rates in general and how they kind of go up and down, and everything in the process from the time that you get under contract until you close. But really, I like to equate the mortgage industry to an iceberg, in the sense that you just kind of see what's above the water level. The part that LOs and agents deal with is above the water level, but below the water line is where most of the iceberg exists. And that's the same thing with mortgage financing and the mortgage market. Most of what happens in lending happens after a loan closes and funds. And normally that doesn't really matter to the lay person, but it's important to understand kind of where we are, to have a basic understanding of how that industry works. And for no other reason, it just educates you on the process and to know why things happen the way that they do. So we'll spend a little bit of time talking about the mortgage market, of how it works and operates, that you can improve your skills and understanding. We'll talk a little bit about what happened here in the last couple of months, with rates kind of doing this a bunch all over the place, how that impacted things and why. We'll talk a little about what's going on then right now in the environment, in the market, and maybe some things that we can expect in the coming weeks and months. And then we'll definitely open it up to some Q&A. If you haven't had any already, we'll open up if any of you have any questions about anything specific that you're curious about. Having been a lender for over 25 years and run and managed lots of companies, I love the mortgage industry. I just think it's fascinating, it's super exciting, and it's something that I'm passionate about. There's something you need to understand and know, the difference between different types of lenders. This is the first thing we want to talk about. And you all should have received an email yesterday that kind of went into this briefly, about the difference between really three types of lenders that are out there, of where someone can go get a loan. We talked about, oops, sorry, my computer just did something funny. There we go. The first level of lending is a mortgage broker. There are great mortgage brokers out there. Many of you probably use them. A mortgage broker typically are smaller operations, mom and pop shops, I like to call them, really good people that do loans, and they have to go out and affiliate themselves with all kinds of different wholesale lenders to get loans done. They can't typically underwrite their own loans. They just package them and then send them out to someone to get everything else done. And they have lots of options and lots of different relationships to get stuff done, but they're not the end user, meaning they're not the one that's making the final decision. They are a broker. They're basically like a middleman that's taking that loan package and finding somewhere else for it to go. That's the first level of mortgage lending. The second level of mortgage lending is what we call a wholesale lender, or not a wholesale lender, but a correspondent lender. Correspondent lender is like a big broker. They still aren't necessarily usually funding their own loans in their own name with their own money. They're typically still trying to go out and find someone to do the loan for them, but they usually are a little bit bigger, have a little bigger operations, and they may have their own underwriter. The final type of lending institution out there is what's called an independent mortgage bank, or a direct lender. That's what Inspiro is. That's what Wells Fargo is, Chase Bank is. That's what all the big lenders are. And an independent mortgage bank or a direct lender is someone that can take your loan directly to the secondary market, hence the term direct lender, meaning it's their funds, it's their money. They make all the decisions. They're the horse's mouth, so to speak. They are the ones that are doing everything on the loan from start to finish, from processing to underwriting to closing it to funding it to post-closing issues. They're dealing with the entire process. And that's something that's in this market. We'll explain why that's such a huge key advantage right now, being a direct mortgage lender versus a correspondent lender or a broker, which some of you may have seen or experienced in some of the relationships that you've had. Great relationships, great companies, but maybe you're struggling a little bit for some reasons. So those are the three types of entities out there. If someone were to get a loan, you'd go to one of those three types of mortgage companies: a mortgage broker, a correspondent lender, or a direct lender. Now let's take a step back and understand a little bit about mortgage and where mortgages go. All mortgage loans end up live and die, breathe on Wall Street, or what we call the secondary market or capital markets. That's where all mortgage loans go. Mortgage loans are pooled together. They're bought and sold and traded on Wall Street, what are called mortgage-backed securities, and large institutional investors buy, sell, and trade mortgage-backed securities in bulk. All loans end up on Wall Street. The only time they don't is if someone is doing what's called a portfolio loan. Maybe you've heard that term before. A portfolio loan is a loan typically that's done by a large financial institution like a credit union or bank, where they are not going to sell that loan on the secondary market. They're going to hold it with their own assets in their own coffers, and they're going to service that loan forever, and they can kind of do whatever they want. And there's business out there, portfolio lending, not a lot, but there's business out there. But traditionally, and for the argument, or for the sake of argument for what we're going to discuss today, if we can conceptually understand that all loans live and die and go and get to Wall Street, it's just how they get to Wall Street that's different. And that comes back to what we talked about, those three different types of lenders. Brokers, in order for a loan to get to Wall Street, have to go through one or two other institutions before it can get there. A correspondent lender has to go through at least one institution before the loan gets to Wall Street. Or a direct lender, there is no barrier between us and Wall Street. Our loans go directly to Wall Street. So there's no markups. It gets there much quicker. There's more options for that financial institution to get things done a little bit quicker. Now, how do they get to Wall Street? What are the guiding principles that get loans to Wall Street? There are three what are called government service enterprises. It stands for GSEs, we like to call them, that dictate lending guidelines for those traditional loans that everyone does. And you've probably heard of those words called Fannie Mae, Freddie Mac, and Ginnie Mae. You may have not heard Ginnie Mae so much, but you undoubtedly have heard of Fannie Mae, Freddie Mac, and then the third is Ginnie Mae. And these are government-sponsored agencies that control lending in the United States. They set the guidelines for traditional conforming loans, the guidelines that we all have to follow when it comes to how much income someone has to make, their credit scores, their debt-to-income ratios, their assets, their reserves, their job history, all that kind of stuff that you guys know about when it comes to a qualified buyer or borrower. And Fannie Mae, Freddie Mac, and Ginnie Mae, they buy most of the loans that are out there. There are investors that buy loans on Wall Street, but for the most part, the GSEs are the ones that drive the mortgage market and buy most of it. As a direct lender, we sell and work directly with Fannie Mae, Freddie Mac, and Ginnie Mae. Why is that so important? Well, why that's important is right now with what's going on with COVID-19 is there really is no secondary market for any type of loan that is not a traditional conforming type of loan. What is a non-traditional conforming type of loan? We're talking about jumbo products. We're talking about non-QM products, meaning things that kind of are a little bit, your bank statement products, or in the old days, your stated income type products, your asset depletion products. There's all kinds of unique products that are out there to get mortgage loans. And those typically are a portfolio loan, but very often they can be sold and bought and traded in the secondary market. But because of what's happened with COVID-19 and the financial impact it's had, there is really no market. There is no secondary market on Wall Street, which are also called capital markets, where people can buy, sell, and trade these unique products outside of conforming types of loans. So if a company has focused most of its efforts on these unique type of products and don't do the traditional kind of what we used to call vanilla type products, your conventional conforming stuff, conventional loans, FHA, VA, USDA, what the kind of business that you do is impacted severely. But also getting those types of conventional loans to Wall Street is impacted because you have to go through one of these intermediaries, one of these wholesale lenders to get your loans to Wall Street. And these wholesale lenders right now are very skittish about taking on further debt and further risk with their loans. And so as a result, many of these wholesale lenders have added what are called overlays, which a term many of you are familiar with, to their underwriting guidelines. they've increased the FICO score requirements, or they've increased the reserve requirements or the employment history requirements, or maybe they just have stopped doing certain kind of loans altogether because they are at risk in this uncertain environment, and they therefore don't want to do it. And so lots of smaller brokers and correspondent lenders have found the type of business they can do has shrunk drastically. Their parameters have increased, making it harder. Their rates have gone up as a result, and therefore they're in a little bit tougher situation. Whereas a direct lender, we don't deal with any of those things because we deal directly with the secondary market with Fannie, Freddie, and Ginnie. We don't have overlays on any of the things that we have. We go directly to Wall Street with our loans. We service them, we package them, sell them, and service them, which is a huge competitive advantage, and which normally you would not see so much in a normal, healthy market or when the getting's good and everybody's happy and busy. You don't see this difference between brokers and correspondent lenders and independent mortgage banks or direct lenders. But when times are tough, this is where direct lenders such as Inspiro really stick out because of the huge competitive advantage we have in getting our loans to Wall Street and not having overlays. For example, I know a lot of lenders out there have increased their FICO score requirements for certain types of loan products, which now make it very hard for a borrower to qualify. We don't experience those type of overlays. Many government loans right now you're seeing where their rates are in the mid to high threes, maybe even the low fours on an FHA, a VA, or USDA loan. For us, because we sell directly to Ginnie, our rates are right now at about 2.75% on a traditional 30-year fixed mortgage. That's FHA, VA, or USDA with a high FICO score borrower. That's because Ginnie Mae is just like Fannie and Freddie, but all they do is government loans. And less than 10% of the lenders out there are affiliated with Ginnie Mae. And it's a huge advantage on the government side of things, so something to keep in mind. But that's one of the advantages that Inspiro has in any kind of direct lender. Many of you probably work with some direct lenders as well, have great relationships, and you should be seeing some of those competitive advantages because they are a direct lender and hopefully have their Fannie, Freddie, and Ginnie tickets. Now, there's a component in the mortgage industry that is important that you understand that really provides liquidity and helps foster home ownership. 50 years ago, 60 years ago, if someone wanted to get a house, the really only option was to go down to a local savings and loan or a bank, and they had to have a really good relationship with their local banker, meaning that banker had to know them intimately. The family or business needed to do business with that particular bank. The borrower typically had to have 50% in a down payment or more to be able to get a mortgage loan, and it was not an easy process. And as a result, home ownership in the United States was in the 30 to 40% range for decades, pretty much forever, up until about 50 years ago when the secondary market emerged with Fannie Mae, Freddie Mac, and Ginnie Mae emerged as liquidity providers in capital markets for mortgage financing. So that now you didn't have to have that individual relationship with the banker to be able to get a loan. And it also provided liquidity in the market for institutions to lend. Again, 100 years ago, 75 years ago, the bank had to have their own money in the bank to give you a mortgage loan. Now there's a whole capital markets on Wall Street that allows for that. And so as a result of this liquidity that increased, home ownership in the United States went through the roof. And we have the highest home ownership rate in the world, over 60%. Last number I saw was 63 to 65%, which is a huge number of adults in the United States that are homeowners. And that's because of this liquidity that's in capital markets because of the secondary market. Well, when a loan closes, there are two pieces to every type of mortgage, to the note that the borrower signs. There's a piece that says, I own the loan, right? And there's a piece that says, I'm going to service the loan. So let's explain the difference between the two. When a loan closes, a loan is no more than a piece of paper, just like a stock. It has value. And that piece of paper can be bought, sold, and traded on the secondary market, just like a stock can be bought, sold, and traded. And that piece of paper, that note and that trust deed is recorded, and that instrument is securitized, meaning it's bundled with a bunch of other loans and sold on Wall Street to all these investors. And these investors, they own these loans because mortgages are a safe return. They're called mortgage-backed securities, and they're a safe return. People make their payments traditionally. There's not a huge default rate. The interest rate return on it's not high, right? Right today, interest rates are in the threes. That's not a huge return, but it's pretty safe, and it's a good investment for people that are looking to put their money in a safe place. So someone owns the mortgage loan, but that owner doesn't really want to have anything to do with the mortgage loan. They just want to get their payments every month. And so the second piece of every mortgage loan is what's called the servicing piece. And someone owns the servicing rights. And what that means is there are institutions out there that collect everyone's payment. You all have mortgages right now, and you make a payment to somebody. Maybe you make a payment to Mr. Cooper or to North Star or to Round Point, or maybe to Wells Fargo or to Chase. There are dozens and dozens of very large servicers out there. A servicer does not own your loan. Remember, someone else owns your loan. An investor owns your loan on Wall Street. The second piece is the servicing rights. The servicer simply has the right and has been hired, so to speak, by the owner to send out your monthly statements, to collect the payments, and to pay your property taxes and insurance, to hold an escrow account when those things become due. And as a result, they get paid a fee to do that. And it's a business. So most big servicers don't own any mortgages, but they have tens of millions, if not billions of dollars in servicing, where they're sending out every month everyone's statements and collecting the payments on behalf of the owners on Wall Street. Well, when the loan closes and funds, mortgage companies sell the rights to Wall Street. They sell the loan, they package it together, it goes to Wall Street. But then the second part, the servicing piece, they can also sell. That servicing piece has value for the reasons I just told you, because the servicer is getting a little paycheck every month when they're handling someone's payment. So that servicing piece has value. And what happens is these servicers bid for the servicing rights of mortgage loans, again, providing liquidity to the market. So for example, if you have a $100,000 loan, let's just use easy numbers for math's sake. There's a $100,000 loan that closes. A servicer will likely pay 1% of the loan amount for the servicing rights of that loan, meaning in this case, $1,000. So they'll pay the mortgage company. Only mortgage banks and direct lenders have this opportunity. Brokers don't do this. Correspondents don't do this. Only mortgage banks do this. So eventually it gets to this part of the process. So even if a mortgage broker originated a loan, eventually we'd get to this point that I'm talking about where an independent mortgage bank would be selling the servicing of a loan. So the servicing company buys this the servicing rights to this $100,000 loan for $1,000. And so they're automatically in the hole a little bit, but they know they're going to get a guaranteed return over the coming years while they're servicing the loan. And it usually takes them about 3 years to recoup that cost, that $1,000, that 1% fee. It takes them about 3 years to break even. The first 3 years, as they're getting paid to service the loan, at the end of year three, they've broken even and they've even money on their servicing rights. And after year three is when they start to make a profit. So obviously, the longer they carry the servicing rights of a loan, the more profitable they come. But there's a whole secondary market for servicing, which is why some of you probably had a loan with XYZ Mortgage, and then a month later or 2 years later, you got a letter that said, hey, your loan's now with ABC Mortgage, because servicing rights get transferred all the time because there is value to them. And if servicing companies need cash, they may sell $100 million of their servicing rights to another company for the same 1%, and they'll get cash in return as a result. Well, servicing is critical to the mortgage industry. Again, it provides liquidity because the servicers are banking on and counting on they're going to keep those loans for at least 3 years to break even. Well, what happens when we're in a volatile mortgage environment, okay, which is what we've been experiencing the last couple of months, and particularly at the beginning of March, when rates plummeted, right? You all saw that. The refinance market, and a lot of your clients heard about it, that were buying homes where rates dropped to the lowest levels ever, the lowest we'd ever seen in the history of the United States. Rates came down to for only less than a week period of time. Well, what that meant is that all those loans that were out there, there's about 30 million loans out there that equal about $10 trillion. It's about the size of the residential housing market. Those 10 trillion loans, those 30 million individual loans, were people that they wanted to refinance as fast as they could and as often as they could. And it put a tremendous strain on the mortgage market because the mortgage market could not handle $10 trillion of refinances in a year. It would destroy and collapse the mortgage market if that were to happen. And servicers were really in a predicament because they had all these loans, right? Servicers, again, they make money after year three. So if someone refinances their loan, they no longer have the servicing rights because it's been closed. And so if someone refinances their loan, they've lost revenue. If they had the loan less than 3 years, they lost a lot of revenue. And so a lot of these servicers started to hemorrhage and lose a lot of money because they had a bunch of loans on their books. Just think of all the loans you've closed as real estate agents over the last 3 years. All those people likely were looking to refinance to get a better rate. And anyone that did, a servicer was losing a ton of money during the course of that period of time. And so servicers, which provide a lot of liquidity to the mortgage industry, were hemorrhaging for a lot of time. And it caused panic and it caused concern in the housing industry over the last 6 weeks. So that's one of the issues that we wanted to talk about. And we'll come back to that, but that's the basics of how servicing works, why they play an important role. That's the basics of how the mortgage market works, and how it plays an important role, of how loans end up on Wall Street, the difference of a broker correspondent lender and a direct mortgage lender, and kind of what happens when the loan closes, the two pieces of every mortgage, who owns it and who services it. These are just some basic things that you want to understand as we kind of dive deeper into this. So what happened, in the last little bit with COVID-19 hitting our shores and all the things that happened in the financial world. Mortgage interest rates historically follow and mirror not only mortgage-backed securities, but another indice called the 10-year Treasury, which you can all follow. It's called the 10-year Treasury. That's a bond that anyone can invest in. It's a 10-year guaranteed note you buy with the federal government with a guaranteed return. And typically the rates between mortgages and the 10-year Treasury kind of go in tandem. So as one goes down, the other goes down. As one goes up, the other goes up. And historically, there's about a 1.5% to 2% difference between the two. So let's say an interest rate was let's say an interest rate's at 4%, just as an easy number. That means the 10-year Treasury likely would be paying back a little bit less than that, 1.5% to 2% less than that. So let's call it, it'd have let's say it's 2%. So it'd have a 2% return. 10 treasuries are guaranteed by the federal government, so therefore you get a smaller return than a mortgage loan because a mortgage loan carries a little bit of risk. So there's usually a 1.5% to 2% spread between the two, always. So if the treasuries went up to 5%, that means mortgage rates would likely be close to 7%. If the 10-year Treasury yield went down to 1%, that means interest rates would probably be close to 3%. So there's just kind of this correlation that you can follow historically and fundamentally that you can kind of follow to help decide what's going to happen with rates. If you follow the 10-year Treasury note, you can kind of see what's going to happen with mortgage rates. It's not always a direct correlation, but 9 times out of 10, you're going to be able to see that. Once the COVID kind of happened and we started to see what was happening in Asia, capital markets, secondary markets are always forward-looking. They don't like uncertainty. They want to know what's going to happen. And so they started to predict that things weren't going to be so good in financial markets. And as a result, lots and lots of people started buying 10-year Treasuries because they thought it would be more safe than putting it in the stock market. Big hedge funds and investment companies either buy Treasuries, which are government-backed bonds, or they stick money in traditionally in the stock market. When the stock market's going to go down, they move their money over to Treasuries. When the stock market's going to go up, they take it out of Treasuries and move it in the stock market. Well, as more people were around the world wanted a safe investment, these big hedge funds and pension funds and governments wanted to put their money someplace safe. The U.S. Treasuries are the safest place in the world to put your money. So as you put more money into Treasuries, as that demand increases and more people want Treasuries, that drives the price of Treasuries up. When the price goes up, the return that someone has to give goes down. That's the yield. And the yield is what correlates to mortgage rates. So as more money was flowing into U.S. Treasuries, the price was going up. That meant the yield was dropping. So the return, meaning the return on that investment was less because supply and demand, meant rates dropped really fast because the 10-year Treasury dropped, mortgage rates dropped really fast because of what was happening with COVID-19 around the world. And that's where we saw this massive drop in rates back at the beginning of March, and which kind of fueled the fire to the kind of refinance boom, one that we've never seen before, ever. This is the biggest refinance boom that we've ever had. And it's put a tremendous amount of stress because it's a lot of loans that have been trying to put through this mortgage funnel. which has probably impacted all of you to some degree with turn times and speed and processes. So all these loans started funneling through the mortgage market at the time of COVID-19 because people were buying bonds and the 10-year treasury like crazy to plant their money in a safe place. And it drove prices really far down. Well, shortly after that, when COVID hit our shores and the economy started to really see the effects of this and massive unemployment, furloughs, all the things that were happening, it's a perfect storm unlike we've ever seen before in financial markets. And so what we're facing right now and what's been happening the last 6 weeks is something that no one's ever seen before. No one's ever been able to predict. There are no models. There are no past histories we can look at. The closest thing we can compare this to is the financial crisis back in 2008, 2009. But this dwarfs that in comparison. But as a result of COVID-19 and this massive upheaval with employment and the economy and jobs, the financial markets and capital markets just started going crazy. And so middle of March, we started seeing rates just bounce all over the place. There was all kinds of uncertainty, what was going to happen. And uncertainty is the enemy, the arch enemy of capital markets and investors. They don't like uncertainty. So you start to get all kinds of erratic behavior, which is what we saw, what was taking place. And so as a result, rates were bouncing all over the place. Then the government stepped in to provide the stimulus. The government stepped in and said, listen, we're going to buy all these treasury notes. We're going to buy all these mortgage-backed securities. We're going to provide all the liquidity that is needed so that we will not run into a liquidity crisis, because that's what happened. That's the lesson we learned from 2008, 2009, is when we ran into that financial crisis then, the capital markets and liquidity came to a screeching halt. The engine, the rotors of the capital system just ground to a halt, meaning no one was giving loans. That's why Lehman Brothers went out of business. That's why all kinds of big mortgage companies like Countrywide went out of business, had to be sold. Financial institutions, banks, is the whole financial market lacked liquidity because everyone wanted to hold on to their money because they were afraid of what was going to happen. And we've got to think of the capital markets like the oil to a car. You got to have it for the engine to run. Otherwise, the engine seizes up and the car dies. That's the same thing with our capital markets. You have to have money constantly flowing through all aspects of capital markets or else it seizes and dies. And so that lesson learned fostered this massive, massive influx of money to the likes that we've never seen before. These trillions of dollars that have been sent out to those that need it, to businesses, but also billions and billions of dollars that have gone into capital markets to help fund small business loans, to help fund capital markets when it comes to mortgages, when it comes to corporate bonds, when it comes to commercial lending. Any kind of lending that's out there needs assistance so the engine doesn't seize, so the oil is still being pumped into the system. So the government stepped in and said, listen, we're going to provide all the capital we need. They, in essence, said, we're going to print money till there's no tomorrow. Those machines are just going to be running 24/7. We're going to pump in all the capital that we need. That's another discussion for, how that's going to play out and having to pay the piper down the road and what's that going to do. But as of right now, it was a great move. It helped salvage things and it helped the system from coming to a grinding halt, which would have been devastating. So it was a very good move by the Fed to be able to do that. Well, that helped facilitate continuing mortgages, and that helped not have a shutdown in lending, because had that not happened, you would have seen most mortgage companies just said, we're out, we're standing on the sidelines, we're not going to lend anymore. And you wouldn't have been able to close any of your deals. We wouldn't have been able to close any of our deals, and it would have been disastrous. So it was a great thing that the Fed did to kind of step in and to help with that. But it caused, in the short term, a few things. And let's go back to how mortgages work. We're going to kind of go back and forth a little bit here. Let's talk about why this was a big impact and a big deal, and why it still is a big deal when it comes to mortgage companies and how interest rates work when you lock them, okay? You all know, a borrower locks in an interest rate at some point in time once they get under contract, whether it's right away or they float a little bit, they lock in the loan. They say, I want 3.5%, lock me in, mortgage company. Well, when that mortgage company issues that lock, the loan isn't technically locked. The lock doesn't take place until the loan actually funds and records and is sold into Wall Street. What that mortgage company is saying is, listen, Mr. and Mrs. Consumer, we promise you the 3.5% that you wanted. We're going to lock it in our system, and we promise that we're going to secure that loan for you when the loan closes in 3 weeks or a month or 6 weeks. We don't know what rates are going to be in 3 to 6 weeks, but we guarantee you 3.5%, even if rates are at 3.7 or 3.2 or 4%. No matter what happens by the time we close and that loan is actually sold and securitized, we promise you 3.5% today. Well, that's a risk for that mortgage company or any mortgage company, because again, they don't know what's going to happen when the loan does fund and record exactly what rates are doing. So in order to offset that risk, what we do is what's called a hedge. We hedge all of our mortgage loans. Every independent direct lender and every loan is hedged. Well, what is a hedge? What does that mean? You're hedging the loan. Think of a hedge just like an insurance policy. It's protecting the mortgage company from that promise. Meaning, Mr. Consumer, we promise you that interest rate, we're going to get you a 3.5% interest rate, even though we don't know what rates are going to be in 3 weeks when your loan closes. And let's say that in 3 weeks when the loan closes, rates are now actually at 4%. Well, we promised them 3.5%, but we bought an insurance policy, i.e. a hedge, that says it doesn't matter what rates are at in 3 weeks. We will be able to securitize and sell a 3.5% interest rate in the secondary market. But there's a cost for that, right? There's that spread. We have to pay a cost to buy that insurance policy and that hedge. And there's an upfront cost to be able to pay for that. And just like the lock implies, whether rates go up or down, we're guaranteeing that borrower that interest rate. And things typically in a normal market work out. Rates move. Rates are living, breathing things. They move every day, as you know. And by the time someone locks until someone actually closes their loan, rates will have shifted a little bit in a normal market, anywhere from 1/8 to 1/4% historically. Not much, 90% of the time. But what happens is if rates move a lot, more than 1/4 to 1/2% during the course of that hedge period, the company that you hedge with, the insurance company, they're called broker dealers, they come calling and they say, listen, your hedge position is very tenuous right now. The interest rate you locked is way out of the market, meaning you are exposed. It doesn't really matter so much if rates go up. Rates could go super high up and you're safe. It's only if rates go down a lot that your hedge is compromised. And that's what happened 6 weeks ago, is most people had locked in that middle to high 3% range on a traditional 30-year fixed, and the market had plummeted, like we talked about, when people bought all these treasuries, drove the 10-year treasury yield down really fast, which drove interest rates down really fast. And now everyone could get, for a few days, you could get a 2.875% interest rate on a 30-year fixed mortgage, lowest rates we've ever seen. So everyone that had locked at 3.5 or 3.625 obviously wanted to change their loan. But more importantly, the hedge companies, the broker dealers said, listen, your hedge is out of the market and you are exposed dramatically. And therefore, you need to now buy additional coverage. You need to increase your life insurance policy, so to speak. You need to increase the coverage on the mortgage loans that you've secured and locked. And we call that a margin call. You may have heard that term before. It's very common in forwards and calls and puts on Wall Street, but it also is applicable to mortgage rates. Anytime you hedge a financial instrument, there's a potential of a margin call. What a margin call means is that broker dealer that sold you that hedge, that insurance policy, says your rates are so far out of the market that you've locked that we need to buy additional coverage to protect you. Or we're going to cancel all your locks and you're basically out of business. And so in order to protect themselves, they have these margin calls that they have to pay. You usually have to pay them pretty quickly within 24 hours when these broker dealers come calling. Well, that may not sound like a big deal, but if you're a lender, say like Quicken Loans or Guaranteed Rate, one of the biggest lenders that's out there, they had margin calls in the tens and hundreds of millions of dollars that they had to pay, or else they had to cancel all the locks for all the thousands of loans they did. So companies, even our side, had millions of dollars in margin calls. Huge financial pressure that was pushed on the mortgage industry. That's what caused so many mortgage companies to go bankrupt back in 2008, 2009, margin calls. The rates changed so much, they had to pay their broker dealers for the hedges they'd secured, and they did not have the cash. And therefore, if you don't have the cash, your loans become invalid and you're out of business basically overnight. Well, the Fed didn't understand the consequences of throwing all this liquidity into the market, that it would cause these margin calls, and it did. Luckily, it didn't last too long. It was a short period of time. It got under control, but those margin calls were relevant to not only mortgage companies, but also to service providers that actually collect payments for borrowers. And so we've had this up and down topsy-turvy of things that have been going on in the secondary market that you don't see on the front end. But what happens on the front end, in the forward market, is rates do this, right? You saw all kinds of up and downs with rates. About 4 weeks ago, things started to calm down. The Fed understood that they can't provide unlimited liquidity. They have to curtail that a little bit. And you've seen now rates they've been very flat for 2 to 3 weeks now. Still in the low threes for conventional loans, the high twos for government loans for the best borrowers. So still some of the very best rates that we've ever seen. And things have kind of calmed down and leveled out. But what hasn't happened is all these non-traditional loans that people normally would get, they are not available. So as I mentioned, if you don't fit inside the little conforming box, right? Meaning a loan amount that's no more than $510,000, that's the conforming loan limit. If your loan amount exceeds $510,000, or your FICO score is below a 640 or a 620, or your debt ratios are over 50%, or you don't have any reserves, or your employment history is not very good, you're going to have a very hard time right now as a consumer, whether you're buying or refinancing, getting a loan, because there is no appetite on the secondary market for anything that does not fit inside that box, inside those Fannie Mae, Freddie Mac, Ginnie Mae guidelines. Because if you fall inside that box, the government provides, because they're government-sponsored enterprises, the government provides some securities for the initial mortgage company that writes the loan. They say that if you follow the guidelines within Fannie, Freddie, Ginnie guidelines, and you followed all the underwriting guidelines precisely and properly, if that loan were to ever default, you're protected, mortgage company. Don't worry. We're not going to come after you for the loss. There's insurance policies in place that'll cover that. Those are called qualified mortgages. And so mortgage companies want their loans to fit inside that box as much as possible, particularly now, because they don't want to be left holding the bag down the road if people can't make their mortgage payments and they foreclose. The four-letter word in mortgage lending, like many things, is risk, R-I-S-K. Everything is about risk. How do we minimize risk? And so interest rates, programs, guidelines, they all have to do with risk. What's the likelihood that someone's going to default on their loan? So all of these, because of what's happening in the financial world, because people are losing jobs, because people are being furloughed, because there's so much uncertainty, there's going to be an increase in delinquencies in mortgages. There's going to be an increase in eventual foreclosures. That's just going to happen. And so there's no appetite on Wall Street, again, where all loans go to live and die, for any loans that fall outside that box. Because if you fall outside that box, the Fannie, Freddie, Ginnie guidelines, there is no insurance to protect you if someone were to default and foreclose. You are left holding the bag forever as a mortgage company. So all those, and jumbo loans don't fall inside the box because they exceed 510. Non-QM loans or bank statement loans or asset depletion loans or cross-collateralized loans, they don't fall inside that box. These portfolio type loans. And so as a result, there is no secondary market for those loans because no one wants to buy them because the RISK is way too high. Now, are there still some banks and credit unions or local savings and loans or thrift shops that still offer some portfolio loans? Maybe, and probably. If you search far and wide, there may be someone in your local market, a bank or a credit union or an independent savings and loan that may still offer a certain type of portfolio loan, but I can promise you they've clamped down on their guidelines drastically because they know that they will be left holding that loan forever if it doesn't perform. So right now, if your consumers don't have a really good FICO score, they don't have a decent down payment if they're not doing a down payment assistance program, if they don't have a good credit score, if they don't have some reserves, if they don't have a good job history, and they don't meet the traditional conventional guidelines for FHA, VA, conventional conforming loans, USDA, they're going to probably have to sit on the sidelines for a while because it's very hard to find any type of financing available. Because there is no secondary market for those loans because no one wants to buy them and take on that risk. So it's important for you to understand and know as you prospect, as you call, as you follow up with clients, some of those basic questions that you ought to be asking about your clients is kind of, where are you? Not everybody knows. Everyone has hopefully an idea of kind of where they sit and stand. But right now, you may not want to be spending a ton of time with the borrower that just doesn't fit inside the box. That's someone that's going to have to get a unique type of product. You can groom them. You can put them on your CRM list. You can follow up with them. But now more than ever, you really want to make sure you are dealing with qualified buyers, because if you're not, you're really wasting your time more so than ever before. And that's why it's so critical that you make sure your clients are fully pre-approved and pre-qualified. And I'm talking about now. If you spoke to any mortgage company 6+ weeks ago and they pre-approved your borrower, you need to make sure they've been pre-approved, because maybe they pre-approved them on March 1st for a loan product that does not exist anymore, and you don't know about it and they haven't communicated it with you. So you want to make sure that the clients that you're dealing with and talking to, you want to make sure that your pre-approval is kind of updated constantly every 3 or 4 weeks, because the guidelines are constantly changing. The GSEs, Fannie Mae, Freddie Mac, Ginnie Mae, they're not changing their stuff too much. They keep them pretty rigid. But if you do deal with a broker or a correspondent lender, their underwriting guidelines are constantly changing, constantly evolving almost on a daily basis. Ours are a little bit, but not too much, because we're a direct lender. That wouldn't stop Fannie, Freddie, and Ginnie from changing the guidelines that everyone has to follow on a moment's notice. That's always a possibility. But just make sure the clients that you're working with, if you have an old pre-approval, you need to make sure and re-up that thing and make sure it's still valid, so that you don't get them under contract or do a bunch of work only to find out they can't get a loan because they were pre-approved on a product or a program that doesn't exist anymore. So I just want to emphasize again the importance of making sure you have qualified buyers that kind of fit inside that traditional lending box, and the huge advantage of a direct lender on those specific types of loans. That's the huge advantage that direct lenders have, is on those Fannie, Freddie, Ginnie conventional conforming loan products. And lenders like Inspiro are the ones that you really want to be dealing with right now in times of crises, in times of uncertainty, because they can get you the best financing, the best terms that are available. So what's happening, right now in the markets? Things have calmed. There's still lots of uncertainty. There's still lots of volatility. All the fundamentals that are out there have been thrown out the window. Right now, the 10-year Treasury, that indice that we look at to compare mortgage rates to, that typically is 1.5% to 2% lower than mortgage rates. Right now, that the yield or the interest rate on the 10-year Treasury has been bouncing between 0.5 and 0.6%. So basically 0.5%. So using normal fundamentals, that would say that the 30-year fixed interest rate should be no more than about 2% above that, so roughly 2.5%. In a normal market, if the 10-year Treasury was at 0.5%, the 30-year fixed rate today would be no more than about 2.5%. Well, that's not the case. Interest rates on 30-year conforming rates, as I've mentioned, are in the low 3s. They are in the high 2s on government loans, but on conventional loans, they're in the low to mid 3s, depending on your borrower. So that's an example of the traditional fundamentals that everybody's used for decades in capital markets, in the secondary market on Wall Street, have just been thrown out the window. What was up is now down. What was down is now up. There's no real rhyme or reason to stuff. It is a day-by-day thing based on what's happening, based on number of COVID cases, number of deaths, number of unemployment claims, number of jobs furloughing people. I mean, all these things. How fast is the economy going to open? When is a state going to open or not? All these things are playing into what's happening in financial markets, because again, financial markets don't like uncertainty. They like stability. They like a plan. And when there is no plan, it causes this instability. So now that we have a kind of a plan, right, that's out there to some degree, markets have calmed, but there's still a lot of uncertainty. And in order to curtail, as I mentioned before, the housing market could not handle, if rates were at 2.5%, everyone in the world, everyone in the United States that had a mortgage would refinance, because no one has a 2.5% interest rate, right? Everyone would refinance, but the market could not handle that. So in order to control that, Fannie, Freddie, the mortgage-backed securities market, Wall Street, has inflated rates a little bit, even though there's at some all-time still low levels. They're higher than they fundamentally normally would be. That's on purpose, because in order to slow the amount of refinance volume that's coming through that pipe, that mortgage pipe that we can only drink and guzzle so much at a time. So Does that mean that rates could potentially come down in the coming months? Yes, they could absolutely come down. There's lots of speculation that we could see rates in the high twos at some point in time in the next 6 to 12 months. But it could just as easily go up to 4%. So there's no real for sure guarantee that's going to happen. What we're telling clients is, listen, if you can, if you're happy with a low 3 interest rate, take it, because we don't know what's going to happen tomorrow. Don't sit on the sideline and hope that you're going to find the trough of the rate. You're going to hit the exact low spot, because no one knows where that low spot is. We need to make sure that we are advising our clients properly that, listen, this is as low as rates have ever been. Take advantage of it while it's here. Yeah, rates could possibly get a little bit lower, but they could just as easily go up. So if you're happy with the rates you're being quoted, I would lock it in, secure it, and not wait to try to speculate and hit the timing exactly perfect, because things could change on a dime, and you could find yourself, 0.5% higher than you thought otherwise. So markets have calmed, things have been fairly steady. I think we'll continue to see that for a while, so long as we continue to see improvements with COVID-19, so long as states continue to have plans about when they're going to open, when they're going to be open for business, when people can go back to business. This is the largest unemployment in such a short amount of time in our history. We've never seen so many unemployment claims ever in this amount of time. The market will rebound and jobs will come back quickly once things open up. But it's probably going to take a little bit of time and a gradual effort for that to happen. So for the time being, you just want to advise your clients that great market, it's a great time to buy. There's definitely good deals to be had. People are still buying and selling. It's harder in some markets than others. It's much harder in California than in Utah right now to transact business, but it's still being done. And it's still a great time to buy if someone is looking to buy and to get into the housing market, because there's rates are to be had and there's good deals to be had that are out there. Now, one of the things that you're hearing a lot about is this whole forbearance / deferment / modification that the government says anyone can have and anyone can take advantage of because of COVID-19. So part of the stimulus package to help was that the federal government said that on all those loans that were underwritten and secured under Fannie, Freddie, and Ginnie guidelines, okay, just those loans, not jumbo guidelines, not portfolio loan guidelines, not wacky loan guidelines, all those loans that fit inside the box that were previously closed, they are eligible for a forbearance if they call their service provider and let them know they've been impacted by COVID-19 and they would like to forbear on their loan or not make payments for a while. And they can do that for 6 to 12 months, which is great for those that absolutely need it. But there's a huge warning that comes with this, and we'll talk about that here for a few minutes, that we have to be very, very careful of. Bottom line is we need to make sure that we all are acting as global citizens of this country and doing things for the common good of everybody. If everybody were to forbear on their loan, or even 25 to 30% of the population did it, it would be devastating to the housing market. The mortgage market would collapse. Home values would drop 50, 60, 70%. It would be absolutely devastating, because if that were allowed to happen, you would never have anyone ever want to invest in mortgage financing again. They just would not do it. There would capital markets, as we know, when it comes to mortgages, service providers, hedge funds that invest, there would be no reliability, no confidence if they were to allow to have everybody just not make their payments. And we'll talk about why that's the case. So as such, I would please, as a mortgage industry professional, I would say, please don't forbear on your loan just because it's free money and you think it's great. It's there for people that really need it, people that are lost jobs, people that are down on income, people that are really struggling. It's wonderful and they should take advantage of it. But if your income is still there, if you still have a nest egg for a rainy day, try to make your mortgage payment as long as you can, because that just protects all of us. It protects everybody's values. It protects everyone's home prices. It protects the housing market in general and financial markets. And let's talk about why that's the case. So this forbearance plan says, again, you cannot make your payments for 6 to 12 months. And the word forbearance or deferment or modification basically all mean the same thing. Technically, they're different, but more service providers, remember, the service providers are the ones you make your payments to. They're the ones responsible to implement these forbearance plans. They're using the terms interchangeably. So one company may call it a modification, one may call it a forbearance, one may call it a deferment, or someone may use a different term, but it's the same thing. But they have no choice. If you fall into those conventional guidelines, you can request a forbearance. And that may be tough to get through to your service provider because so many people are. But really right now, only about 5 to 6% of all loans are being requested. That's the latest data this last week. Of all mortgage loans, about 5% have requested a forbearance. Now that number is probably going to go up. It may double, but hopefully it doesn't get much above 10%. The service provider, it's up to them and you, the consumer, how that's going to work, because forbearance does not mean forgiveness. You're going to have to pay the piper at some point in time. That interest is still going to accrue. So if you decide that you're not going to make your payments for 6 months because you entered into a forbearance, that just doesn't just vanish into thin air, poof, and it's free money. It's going to be tacked on to your loan one of 3 ways. Number one, when you come out of forbearance, you can just catch up with one massive payment of $30,000. Well, no one's going to do that, but that's an option. You can catch up with your payment when you're ready to start making payments. Number 2, it can be amortized over the remaining life of your loan. So you miss payments for 6 months, let's say that's $15,000. They can add that loan balance to the life of the loan, re-amortize it, and your new mortgage payment when you come out of forbearance may go up 15 or 20 bucks a month. It's going to go up for sure when they re-amortize the loan. Number 3 is they just tack those 6 payments onto the back end of your loan, and instead of paying your loan off in 25 years like you were, you're now going to take 26 years to pay it off, which is a lot more accrued interest. Bottom line is it's going to cost you a lot more than just your payments to forbear. It's not just the $1,000 house payment that's going to be, you have to make up. It's going to be the $1,000 plus all the interest over the remaining life of your loan, which could be twice that amount. So if you forbear and you skip $15,000 worth of payments, it can actually cost you $30,000+ in total payments over the life of the loan or by the time it's all said and done. So just something to keep in mind. Again, it's there for a reason. Let's only use it if we absolutely need to and it's needed. Don't do it as an arbitrage situation of, I'm going to take advantage of it because I don't have to make a payment if you really can continue to make your payment. That's just going to benefit everybody. But you need to go to the service provider to make sure to work out those details. Now, you may be thinking, well, how's that going to work? How, if the service provider is responsible and contractually obligated to pay the investor on every mortgage loan, meaning whether you or I make our mortgage payments or not, the service provider has to pay the investor their principal and interest. They're contractually obligated. If they don't, they pay fines and penalties, and they have reserves that get used up. And if those reserves eventually get used up, they're out of business. Excuse me. So service providers have to pay the principal and interest payment to the end investor, whether you and I make our mortgage payments or not. But wait a minute, the government just said that we don't have to make our payments because of a forbearance. Yes, but that doesn't preclude the service provider from having to pay the investor. They still have to make it. Well, how is the service provider ever going to do that if millions of people stop making their payments, yet the service provider has to make their payments for them to the investor? They'll eventually go bankrupt and go out of business. Well, the federal government has stepped in and is providing short-term intermediary loans to help the service provider make those principal and interest payments to the end investor so that everyone is made whole. Again, that's more capital infusion to make sure everything's okay. But the property taxes and insurance isn't part of that deal. So the property taxes and insurance that are still required to be paid for the consumer on their mortgage still have to be paid by the service provider, whether they're making their payments or not. So service providers are still going to be short some cash and still going to be left on the hook for a lot of things. And they all have deep reserves because they have to, but it can't go on forever. And so again, that's a reason why we all need to make our payments if we can, because these service providers, which are so crucial to providing liquidity, if service providers go away, there is no secondary market. If there is no secondary market, we step back in time 75 years where you have to have 50% down on your house and you have to have a personal relationship with your banker that's on the corner. We don't want that. That will destroy the housing market as we know it and destroy the businesses and the lives and the careers that we've created. So we want to make sure that we're doing our part to make sure that we're making our payments, advising our clients that may ask about forbearance that yes, use it if you absolutely need to, but if you don't, please don't. I'm almost done with my list here. So if you have any questions, I can't see all your hands, but if you put a question in the chat, I don't see any right now, but if you have any questions, just put them in the chat about anything. I can try to find you or unmute you, or I'll just answer the question if you have anything about anything we've talked about. This is information overload. I understand it. It's very technical. It's probably more than you ever needed or wanted to know. But this is a time when the more you know, the better you're going to be, the better agent you're going to be, the better advice you'll be able to give, the better you'll be able to give your client the services that they need. If you can be that trusted financial person to some degree, it's just going to help you in the business that you're trying to continue to push forward. But it's also going to set proper expectations, right? This is not a normal environment where, hey, we can expect to get stuff closed in 21 days. We work on a 21-day cycle. Things are just not going to get done that fast because there's so many loans. We're seeing delays with appraisals. Sometimes it takes a little bit longer. We need to make sure we're setting proper expectations with people. You probably need to have a little bit longer. I would advise you on your purchase contracts. You probably ought to be putting in probably 40 to 45 days at a minimum on them just to be safe because of volume constraints, because of appraisal constraints. That's one of the huge shortages we have in the mortgage industry is with appraisers. We do not have enough appraisers because it's such a huge barrier to entry to become an appraiser. And they can only do so much. And when we have massive volumes like we've seen the last 6 weeks, it just naturally slows things down. So one bit of advice is to for sure just make sure you're setting proper expectations with clients, making sure they're pre-qualified before you start showing them homes, making sure that you're working with that listing agent to not, and as a listing agent, if you have listings, don't set unrealistic expectations because this is not the same world we lived in 2 months ago. And it's for all the reasons we've talked about, it's fundamentally different. And you just need to make sure you plan for maybe a little bit further time so that everyone doesn't freak out if the loan doesn't close in 21 days, if it takes an extra 2 or 3 weeks. All right, we have a few questions here. Let me look at these here real quick. One question from said, I thought this Federal Reserve sets interest rates. Great question. Federal Reserve meaning the Fed. The Fed controls monetary policy, and this is a huge, very common misconception when it comes to the Fed, in that, if you're watching CNN or MSNBC, they talk about the Fed raised interest rates or the Fed lowered interest rates 0.25%, and everyone automatically thinks, oh, that must mean all interest rates and mortgage rates went up or down accordingly. That's not the case. The Federal Reserve's two main priorities in life and why they were created is to control inflation, to keep inflation below 2%, and to keep unemployment as low as possible, or to have as much employment as possible. That's their mandate, those two things: low inflation, low unemployment. And that's what they do. And everything they control has to do with that. But they are the purse strings, right? They have the money in the United States to control monetary policy. The interest rates that the Fed controls are what are called short-term interest rates. The Fed controls the interest rates that banks lend to one another every night based on liquidity requirements. If you're an FDIC insured bank, if you're a Wells Fargo, a Chase, a Bank of America, any credit union, if you're an actual brick and mortar bank that does checking, savings, kind of traditional banking, you have to have certain liquidity requirements at the end of every business day based on the amount of deposits you have. You have to have X percentage of those deposits in cash. And so at the end of every day, every bank in the United States has to do a quick audit to see how much money they have in their coffers. And if they're short, they've got to get money put into their coffers to meet requirements or they get penalized severely. The best way to do that is to do a really quick loan with another bank and do a wire transfer and say, hey, listen, I'm $100 million short. Can you lend me money until tomorrow when I can get this resolved and to meet the liquidity requirements? And bank one says to bank two, you bet, here's $100 million. And in order to avoid them being taken advantage of, the Federal Reserve sets the rate. It's called the Fed funds rate. They set what that rate is that they can lend to one another. So it's consistent. So no one's taking advantage of someone else because everyone's going to run into this issue. That's a short-term interest rate, a very short-term interest rate. So as a result, that short-term interest rate dictates what the bank then lends on car loans, CDs, savings accounts, any type of short-term loan. Usually a short-term loan is less than 5 to 7 years, is a short-term interest rate. So the Fed controls short-term interest rates. The rates on your credit cards, those are short-term loans. So when the Fed moves those types of rates, it only impacts short-term interest rates. Mortgage rates are not a short-term rate. Mortgage rates are long-term rates. They're 30 years. So the things that the Fed does not directly correlate to what happens in mortgage rates. So get that out of your mind right away. When you see the Fed changing rates, it has zero impact on what's going to happen with mortgage rates. Sometimes rates will go down if the Fed lowers rates, but it could just 50% of the time they could go up just as well for all kinds of other reasons. So the Federal Reserve does not control mortgage rates. The Federal Reserve controls short-term interest rates. And when they move, it affects your credit card, your student loans, your car loans, your savings accounts. It does not affect mortgage rates. And it's a great thing to understand because your clients will see that. And you may be in the middle of a purchase deal down the road and the Fed lowers rates and they think, oh my gosh, my mortgage rate's going to get lowered. No, that controls more short-term rates, not long-term rates. Good question. Another question, are there still no down payment assistance loans available? The answer is yes. There are still no down payment. Those are local in nature. Most states have what are called DPA, down payment assistance programs. California, there's CalHAFA is the most popular one. In Utah, it's called Utah Housing. Every state, many counties, many cities have down payment assistance loans. Those loans are tied, meaning the loan you get is an FHA loan usually on those. Not always, but 90% of the time you're securing an FHA loan in conjunction with that down payment assistance. And those loans are still available. Down payment assistance lenders, government agencies have not shut that off. They're still lending on those programs. So speak with your local loan officer or mortgage company to find out, make sure that the DPA program in your area is still available. But for example, I'm sitting here in Salt Lake City and the Utah Housing Loan is still alive and well, and we're closing those every day. Can we get a recording of this? I'm hoping Russ recorded it. It looks like he did, so I'm assuming yes, you can.
Yeah, we'll send it out.
Okay. What are some examples of wholesale lenders? So wholesale lender, you'll never really know a wholesale lender because they don't deal directly. So we talked about brokers and correspondent lenders and direct lenders. In that food chain, there's also a group that's called a wholesale lender. A wholesale lender is like a mortgage bank, except they don't deal directly with the consumer. All they do is want to lend to a correspondent lender or a broker. They're kind of a middleman to get the loan to Wall Street. And there's a whole bunch of them. There's Provident Funding's one, Penny Mac is one, Freedom Mortgage is one. There are a lot of very big lenders that do both. So Guaranteed Rate, Quicken, they have a whole separate division that just does wholesale lending. They just deal directly with brokers. But those big companies also deal directly with the consumer. So there's most companies specialize in one or the other, but some of the big boys, they kind of put their hand in all three aspects of the lending process. Good question. Let's see here. Does Inspiro sell their servicing? Great question. So as an independent mortgage bank, we told you there's two pieces to that loan. When we close the loan, there's the piece that gets sold to the investor on Wall Street and the servicing piece. Inspiro, we're a direct seller servicer, meaning that servicing piece we can hold and retain if we want. And we do. We retain a certain percentage of all of our loans, and we are the servicer. We're the ones that the borrower makes their payments to forever. There's no rhyme or reason to that. We kind of look at that on a loan by loan, month by month basis based on where we get paid the most. If we get paid more to hold the servicing, we'll hold the servicing. If we get paid more to sell the servicing rights, we sell the servicing rights. All borrowers usually make their first one or two payments to Inspiro or PMG, Panorama Mortgage Group. That's our holding company. That's the name that things are usually done in under Panorama Mortgage is what the name on the mortgage statement. But yes, Inspiro does service. We don't service a lot. We're servicing more and more, but that is something that's a possibility, but there's no rhyme or reason to the loans that we service. So we just kind of look at that on a month by month basis. Let's look here. Great. I don't see any other questions. If you have any, feel free to reach out. We've got fantastic, obviously, loan officers in California, fantastic loan officers here in Utah that can service all of you. Our loan officers are very experienced. Most have decades of experience in the industry. There aren't really many loans they haven't seen or done before. Hopefully you've learned a little bit about the huge competitive advantage we have. That's not to disparage any other company out there. There are all kinds of fantastic companies out there. The big difference between Inspiro and those is that we are affiliate lender of Everest, and everything we do is geared towards all of you. Our business model, the way that we've set up our systems, it's all geared towards Everest. We don't market outside of Everest. That's our focus. We have blinders on, when it comes to the things we do. And as such, we want to be here to help you to make sure your businesses grow and flourish and prosper, and that we're giving your clients sound advice, sound information, and walking them through the process so that you look like a rock star and the things get done in the way that they should. Had another question here real quick. What are the credit score requirements for the DP assistant programs that are still available? You're going to need to talk, great question. What are the credit score requirements for these DPA programs? They vary by DPA. All DPAs are totally different. Typically, most of them require at least a 660 or above FICO score, but some will go lower than that, and they're different based on where you are. So you're going to want to reach out to an Inspiro loan officer to talk to them about any DPA programs and to see if your client qualifies. The DPA programs are fantastic. They are stringent, meaning there are usually income limitations to those, meaning you can't make $250,000 or $500,000 and qualify for a down payment assistance program. There's income limitations. There are also loan amount limitations, so you can't buy $1 million home with the DPA program. There's going to be restrictions by county based on the program, but they're a little bit looser in some of their other restrictions because they're trying to foster home ownership. The rates for those DPA loans, just so you know, are not the rates that I've been quoting you. They're going to be higher for sure because it's 100% financing, which carries a much greater risk than someone that has a down payment. So you may have the interest rate maybe 1 to 1.5% higher than what the going rate is because the borrower's coming with no money. And it just poses a much greater risk for the state agency that's issuing that. So those 2.75% interest rates on an FHA loan today, that's not going to be available on a DPA program. That's only with someone that has a 3.5% or more down payment. So just keep that in mind. A great question. All right. Let me just look at my list here, make sure I didn't cover something that I wanted to go over. We talked about the market, how it works, capital markets, hedging, servicers, margin calls, what's been happening, what we can expect, where rates are today, a little bit about forbearance, a little bit about the differences between different lenders. Guidelines are being tightened all the time, so keep in mind that. Fewer options, and we want to make sure these borrowers fit inside the box. If you have any questions, you're more than welcome to reach out to me anytime. I probably would advise you reach out first to just a local loan officer, but I'm always here to help in any way possible. We just want you to know that we love you. We're concerned about you. We're in this together. The Everest family is a big family, which we're part of and grateful to be part of it. We love the people that we deal with. We love working with all of you. We really want to foster more relationships with you. If we're not working with you already, we hope to do that in the future. We'd love to continue to educate, to continue to teach. The things that we're doing with you today, we obviously don't do with consumers because that'd be a little much. But we definitely want to make sure that people understand the process, that it's very transparent. We don't hide anything. All of our cards are faced up on the table. And the type of experience that you would want is the kind of experience that we want to give to you and to your clients. So I don't have anything else, Russ. Just really appreciate the time and hope everyone learned something from it. And now is a little bit more educated and can be better agents as a result.
Awesome. Thanks, Christopher. Appreciate it. Thanks, everyone, for being on.